If you think investing in the stock market is safe, then you need to watch this video, because what I'm about to tell you in the next 10 minutes might permanently change the way you think about investing. The stock market is broken. And maybe permanently. Look, I know you've seen it too. Some guy on Reddit turns 50,000 into $1 million in a single week, and then proudly posts a screenshot like he just unlocked the capitalism speedrun. On Twitter, some guru is standing in front of a Lamborghini, saying, "Stocks only go up, bro. Just buy the dip." And honestly, it's entertaining. Watching capitalism get speedrun is addictive. This is FOMO. This is greed. This is a dopamine rush. But while watching all this, there's also an uncomfortable feeling, a doubt, a fear, a question. Is this real? Or is this just a game? And if you felt that too, you're not alone. Because there was a time when the stock market actually made sense. A time when investing meant analysis, reading earnings reports, understanding cash flows, decoding company fundamentals. Boring? Yes. Reliable? Absolutely. If a company was good, profitable, and growing, its stock price went up. If a company was failing and losing money, its stock crashed. Simple. Markets had gravity. Ignore fundamentals, and eventually reality would catch up with you. In the 1970s, large-cap stocks formed a bubble, then crashed. In 2000, the dot-com bubble drove everyone crazy. Then came the reality check. In 2008, banks inflated the housing market, then everything collapsed. Every single time, fundamentals won. Markets could stay irrational, but only for so long. Eventually, gravity kicked in. But now, something different is happening. Markets and fundamentals are in the same room, but they're not talking anymore. That relationship is broken. Look at GameStop. Fundamentally, the company was struggling. Weak earnings, questionable future growth. But the stock price? Up 1,500% in days. Why? Because Reddit decided. Because the narrative was strong. Because enough people believed. AMC, Tesla, crypto, NFTs, meme coins. Everything is narrative-driven. Everything is emotion-driven. And this isn't just confusing retail investors. It's confusing professionals too. Remember Michael Burry? The guy who predicted the 2008 housing crash. The guy who made $800 million while the world collapsed. The guy Hollywood made a movie about The Big Short. This man was a fundamentals purist. When everyone was greedy, he was rational. When everyone was blind, he saw clearly. And in 2024, he shut down his hedge fund. Why? His own words, "My estimation of value in securities is not now and has not been for some time in sync with the markets." Translation? Markets are no longer driven by fundamentals. This is the guy who trusted gravity and built a fortune on it. And now he's saying, maybe gravity doesn't apply anymore. And this isn't just stocks, gold, real estate, equities, crypto. Everywhere. The same story. So if a legend like Michael Burry is confused, the real question becomes, if fundamentals aren't driving markets, then what is? To understand this, you need a new lens, a new framework. Behavioral finance. Traditional finance says, markets are rational. Behavioral finance says, markets are human, meaning markets move on emotion, fear, greed, FOMO, herd mentality. These are psychological biases that move prices. This isn't a new idea. In the 1970s, psychologists Daniel Kahneman and Amos Tversky proved that humans don't evaluate risk objectively. We feel losses more than gains. We anchor to narratives. We instinctively follow crowds. For decades, investors ignored this. They thought behavioral finance only explained anomalies, bubbles, and panics. But after 2020, everything changed. 2020 wasn't just a health crisis. It was a financial rewiring. Money printers went brrr. Interest rates hit zero. Stimulus checks flooded the system. Millions of new investors entered the market from their homes. Robinhood, Zero-Da, Grow. Trading was gamified. And what did these new investors learn? Buy the dip. Stocks only go up. That phrase should make you uncomfortable. Not because it's wrong, but because it keeps working. And when a strategy works too many times, it stops being a strategy. It becomes an assumption. And when assumptions drive markets, fundamentals become secondary. Old rule. Invest long-term. Buy quality companies at fair prices. New rule. Buy the dip. Follow momentum. Catch the narrative. And this isn't limited to retail traders. Institutions adapted too. Bloomberg, Goldman Sachs, JP Morgan. They now track sentiment, scrape Reddit threads, analyze Twitter trends. Why? Because these signals predict short-term price movements better than traditional metrics. This isn't a minor shift. It's an operating system change. Markets no longer price cash flows. Markets price attention. So now, the real question is this temporary or permanent? Is this just another bubble that will eventually burst? Or has the market's DNA fundamentally changed? History says, this is a phase. Gravity will return. The present says, the rules have changed. This is the new normal. And to understand what comes next, you need to understand the real game, because narratives now move at the speed of light. Before, stock tips came through newspapers. You called a broker. Trades executed hours or days later. Now, you wake up, scroll Twitter. An influencer says, XYZ is the next Tesla. You brush your teeth, check your phone, hit buy, 5 minutes. Information to execution, 5 minutes. Narratives that once took months now spread in hours, sometimes minutes. And when information moves this fast, there's no time for analysis. By the time you check fundamentals, the price has already moved. Take GameStop. January 2021. A struggling retail gaming store. Amazon and digital downloads made it nearly irrelevant. Declining revenue, closing stores, shrinking margins. Any traditional analyst would say, avoid this stock. But Reddit's Wall Street Bets said, what if we don't care about fundamentals? They noticed hedge funds were heavily short, so they made a plan. If we all buy together, we can crush the shorts. And that's exactly what happened. The 13th of January 2021, $20 per share. The 28th of January 2021, $483 per share. Up to 315% in 15 days. Wall Street panicked. Hedge funds lost billions. Trading platforms restricted buying. Congress held hearings. But the most important thing? Fundamentals played zero role. This was pure narrative power, collective belief. An us versus them story. And when enough people believe the same story, prices detach from reality. Now look at Tesla. Tesla is a real company. Innovative. Visionary. Elon Musk, genius and chaos combined. But its valuation? That's a different story. 2019 market cap, $75 billion. 2021 market cap, $1.2 trillion. 16 times growth in 2 years. In 2020, Tesla deliveries 500,000 cars. Toyota deliveries 9 million cars. Tesla revenue, $31 billion. Toyota revenue, $275 billion. Market caps? Tesla, $1.2 trillion. Toyota, $250 billion. A company making 10 times fewer cars, worth 5 times more. Fundamentally, it makes no sense. Narratively, perfect sense. Because Tesla isn't just a car company. It's a movement, a belief system. One Elon tweet, stock up 10%. One meme, up 15%. One controversy, massive volatility. Traditional investors say, it's overvalued. Tesla believers say, you don't understand the future. Both can be right. But the point is clear. Narrative is now more powerful than fundamentals. And if you want the purest form of this, look at crypto. Bitcoin, Ethereum, Dogecoin, Shiba Inu. No cash flows, no products, no earnings reports. Traditional valuation? Zero relevance. Yet, Bitcoin at $69,000. Ethereum at $4,800. Dogecoin, a literal joke, reached a $90 billion market cap. $90 billion for a meme. Where does that value come from? Belief. Enough people believe something has value, and value is created. That's network effects, collective psychology, modern economics. And it's not limited to crypto. It's the market's new operating system. You might think, this is just retail madness. Institutions are smarter. Wrong. Institutions joined the game. Goldman Sachs launched Reddit sentiment tools. JP Morgan hired social media analytics teams. Bloomberg created Twitter mention indexes. Why? Because ignoring narratives means losing. Wall Street didn't beat retail. Wall Street joined retail. This isn't surrender. It's evolution. But remember, this isn't the first time markets went insane. Tulip mania. 1929. .com bubble. The difference now? Friction. The 1990s. Slow internet. Expensive trading. Fragmented information. The 2020s. Instant internet. Free trading, viral information, bubbles that once took years now form in days. And when speed increases, crashes become violent. So here's the reality check. Yes, markets are narrative-driven. Yes, fundamentals are secondary. But this can't last forever, because if prices stay disconnected from reality permanently, the system breaks. And when it breaks, it's brutal. So we have two possibilities. Option 1. This is a bubble. Gravity returns. A crash comes. Option 2. This is permanent. The rules have changed. And you have to decide. Which side are you on? Tell me in the comments. Is this a bubble or the new normal? And if this video helped you see the market differently, like the video and subscribe, because this financial journey is far from over.